Welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined down the line by Nick Stamenkovic to talk tapering, sentiment and the US. Nick, the latest string of economic data has suggested a strengthening global economy. But how much weight does macroeconomics have on investors? Is this optimism reflected in sentiment, would you say?
Well, I think the key issue at the moment is the Fed and when they're going to start unwinding QE. And any data that suggests the US economy could be strengthening is adding to fears that the Fed will start tapering QE possibly as early as September's FOMC meeting. And we've seen that reflected in a correction in equity markets this week, particularly in the US, but also Asia. And US government bond yields grew to two-year highs for 10-year yields, testing the 1.8% level.
As you mentioned, slowly improving US jobs data and rising consumer prices is likely to add to the September tapering conversation. Do you think this latest data set has indicated the downward potential capable of destabilising a sluggish economy has abated?
Yes, I do think so. I mean, the US consumer has been quite resilient despite the fiscal tightening we saw start of this year. And the retail sales figures, which are the first major data come out at the beginning of the week, surprised the upside, particularly the core rate. And that suggests that consumer spending started the third quarter on a firm note, which is quite encouraging. However, the corporate sector seems to be a bit more cautious. Industrial production stagnated in July, and forward-looking surveys like the Philadelphia Fed and Empire State Manufacturing Indices actually fell back slightly, though they did remain in positive territory. The housing market looks in pretty good health despite the recent rise in mortgage rates. And probably the most important figure for the Fed was the weekly jobless claims, which dropped to their lowest level since October 2007, suggesting the labour market may potentially be gathering momentum. Hence, I think the Fed can be confident that the US economy could withstand an unwinding QE, and I think the market's increasingly betting that the Fed will indeed start unwinding QE and tapering QE at September's FOMC meeting.
Indeed, financial markets do seem to have positioned for the Fed to start paring its bond buying in September. Despite conflicting signals from policymakers and muted inflation data combining lately to undermine this conviction, do you think it's now not a matter of whether the Fed will taper in September, but by how much?
Certainly, if you look at the reaction of the equity markets this week, we have seen quite a significant sell-off, and that suggests to me that equities, particularly in the developed world, US, Europe, and indeed Asia, clearly hadn't fully factored in the possibility of a move early September, whereas we've already seen a sharp move in yields, 10-year yields in treasuries since the summer, although we saw a further rise this week. The Fed itself, we've seen conflicting comments from various officials. I think the most significant comments were from Mr. Bullard, who dissented, if you remember, in June against the Fed's FOMC statement, expressing concern about inflation. But in July, he removed that because the Fed said they were worried or expressed concern that inflation could persistently be below its 2% target. The latest inflation data, the CPI figures, showed the core rate actually stabilising. So that should reassure the Fed officials even further. So I think the chances are growing that the Fed will move in September, and I think the markets are starting to react to that, not just government bonds, but equities as well.
Continuing on the topic of yields, the end to the Fed's bond buying has dominated markets as it's likely to boost US Treasury yields and support demand for the dollar. What is your outlook for these moving forward?
Well, we've seen a very sharp sell-off in government bond yields in the States, starting June, July. We've already touched 1.8%, which is the highest level for 2 years. I would expect we see a period of consolidation near term, depending on what the tone of the FOMC minutes this coming week are, and obviously the upcoming employment report and the key FOMC meeting in September. But I wouldn't rule out a further modest rise up to year-end. We could even, potentially go up to 3%, but I think that's more likely to take place in 2014 rather than 2013. The overall medium-term outlook is one where sovereign bond yields, particularly in the US, are going to rise gradually higher as the economic picture improves. The Fed slowly moves towards a potential rate hike, and the global economy as a whole heals. This bodes well for the dollar, particularly against the euro, where the European economy is lagging behind that of the US, and the ECB has adopted forward rate guidance, a soft version to keep interest rates low for a prolonged period, whereas the Fed is looking to unwind some of its central bank asset purchases and eventually raise interest rates. So I think that the dollar has scope to rally against the euro, but less so against the yen. It should also appreciate against the pound, where the Bank of England has expressed concern about the recent rise in money market rates.
Nick, thank you so much for your time and perspective today. Well, that's all from me for the moment, but it's a busy day for the TV team as we have press review, weekly wrap-up and targets and focus to bring you, so please do click back to the website. Bye for now.